Welcome to StaalX Construction and Steel Podcast. Episode 13, Backlogs Fall, Confidence is Up. Which data is correct? Before we start, quick shout out to StaalX. If you work with steel, rebar, wire rod, mesh, any of it, StaalX makes your life way easier. You can check real prices, get instant quotes, and order everything online without waiting on emails or chasing people down. Super simple, super fast. If you haven't tried it yet, head over to StaalX.com and make a free account. Alright, now back to the episode.
Welcome to the deep dive. Today, we're jumping into the U.S. construction market, and it feels like we're looking at two completely different realities right now.
It's a profound paradox, really. I mean, you read one headline, and it says home builder confidence is hitting an 8-month high.
Which sounds great.
It sounds great, right? But then you look at the commercial side, and the data says backlogs are falling sharply, profits are getting squeezed. The numbers are basically yelling opposite things at us.
Exactly. So our mission today is to resolve that conflict. We need to figure out how high confidence can exist at the same time as, plummeting profitability.
And we have the tools to do it. We've got data from the Associated Builders and Contractors, the ABC, on the commercial side.
We also have the National Association of Home Builders, or NAHB, covering the residential mood, and a really crucial report from StaalX on the steel market.
And when you pull these three threads together, you realize the market isn't just segmented. It's a K-curve economy. Some folks are soaring, while most are struggling just to keep their pipeline full. We're going to help you figure out where that dividing line is.
Okay, so let's start where the pain seems most obvious. The commercial and industrial sector. This is from that ABC data.
Right. And when we look at the amount of work contractors actually have secured their backlog, the news is pretty tough.
That's the Construction Backlog Indicator, or CBI, and it fell sharply in November 2025.
Yeah, that drop is... It's pretty big. The CBI fell to just 8.1 months.
8.1, and what does that mean in context?
Well, that secured pipeline is down 0.3 months from just the month before, and it's also down from the same time last year.
So it's the lowest it's been in a while.
It's the lowest level for secured work since early 2024. For your average commercial contractor, that safety net of future jobs is getting pretty thin.
Okay, so here's the initial head-scratcher. The actual work is shrinking, but the mood, the Construction Confidence Index, the CCI, it's still optimistic.
Stubbornly optimistic.
Right. Contractors are still saying they expect growth in sales and in staffing. It's keeping that CCI reading above the 50-point threshold for expansion.
And that's where the segmentation really starts to show. You have contractors saying, I don't have much work lined up, but in the same breath they're saying, but I think sales will go up.
But that optimism isn't making it to the bottom line, which is what really matters.
Not at all. That's the real indicator of health.
I see. So if they expect sales to grow, why are profit margins taking such a big hit? The data is really clear on the pessimism there. Only 33.6% of contractors expect margins to expand.
That number is the canary in the coal mine. It's the lowest share we've seen in over a year.
So 2/3 of contractors are expecting margins to either shrink or just stay flat.
Exactly. Even if sales go up a bit. And when sales are positive but profits are flat, it means something outside their control is eating away at their ability to make money.
And the chief economist for the ABC pointed right to it: rising materials costs. They've started to trend up again.
Which brings us to steel later on. But first, we really need to understand who is feeling this backlog pain, because it's definitely not everyone.
And this is where the paradox just breaks wide open.
It does. The decline in that backlog wasn't spread evenly at all. It was severe for small and mid-sized companies. But for the huge contractors, those with over $100 million in annual revenues,
the decline just disappeared.
It disappeared. Their backlogs are actually holding steady. Some are even slightly up.
So we have a really clear dividing line based purely on the size of the company. The smallest contractors, under $30 million in revenue, they logged their lowest backlog in over 4 years.
While the big guys are basically fine. And it all boils down to one single, highly specialized sector: data centers.
This massive, capital-intensive construction boom is creating a two-tier market.
Completely. And you need to see the numbers here because they are just astonishing.
Okay, let's hear them.
For those small contractors who are struggling, fewer than 6% of them are currently under contract for a data center project. They're not even in the game.
Not even participating. Now, what about the giant contractors? The ones over that $100 million mark?
A staggering 37% of them are currently involved in building data center infrastructure.
37%.
That's the entire story right there.
So the overall commercial confidence index is essentially being artificially inflated by a very small group of companies riding this AI wave.
Absolutely.
Yeah.
If you're a general contractor building, say, a strip mall or a mid-sized office, your market has cooled off in a big way. But the sheer scale of these data center projects is masking that pain in the headline numbers.
So the takeaway for you is this major dislocation in the market. The specialized demand for AI infrastructure is thriving, but it's sucking resources, materials, labor away from the traditional commercial sector.
Pushing smaller firms into their worst backlog positions in years.
Now that we understand that commercial fracture, let's pivot to residential. This is the source of that 8-month high confidence headline.
Right, the NAHB Wells Fargo Index. It rose in December, hitting 39.
Which, again, an 8-month high sounds really robust, but we need to put that number, 39, into its proper context.
Context is everything.
Yeah.
That index uses 50 as the break-even line. Anything below 50 means more builders see conditions as poor than good.
So while 39 is an improvement, the overall market view is still negative.
It's moving from very poor to just moderately poor.
Okay, so what's driving even that small bit of optimism?
It's the slight drop in borrowing costs. Mortgage rates are hovering near their one-year lows, around 6.3% to 6.4%.
And that's just enough to get some buyers off the fence.
It's enough to nudge some reluctant buyers into the market. Builders are seeing a flicker of activity where there wasn't much before.
But, and this sounds familiar, this activity is coming at a major cost. It seems to confirm that profit squeeze we were just talking about.
It absolutely does. They're having to offer huge concessions. The source data is clear. 67% of builders reported using sales incentives.
67%. That's a post-COVID record high.
It is. And maybe even more telling, 40% of them reported actually cutting the base price of the home. They're just sacrificing margin to move inventory.
So the confidence isn't really about what's happening right now. The present sales index is only at 42.
Exactly. This confidence is purely a bet on the future.
The gauge for sales expectations for the next 6 months, that's what's driving the headline.
That's the key. That gauge climbed to 52, finally getting over that break-even level. Builders are enduring the pain now, but they're betting that 2026 will see a pickup. Mostly because 2025 is expected to end with a 4% drop in closings.
They see a low bar, and they're just hoping for better affordability next year.
Okay, so we've established two things. Small and mid-sized commercial contractors are struggling with backlogs. Residential builders are struggling with price concessions.
And both of those pressures point right back to that same source of anxiety, material costs.
Which brings us full circle to that StaalX steel market report. And this report just closes the loop on the entire thing. It confirms the pressure. The steel market is very active, prices are rising, and the upward trend is projected to continue well into the first quarter of 2026.
And this isn't random. It's tied directly to the doubling of steel tariffs back in June 2025.
Right, which immediately restricted supply and pushed domestic prices way up. Flat-rolled steel is driving that momentum, and scrap prices alone are expected to jump by $20 a ton in December.
That kind of predictable cost jump just hammers every construction budget.
And this is where the AI connection becomes the unified theory for this whole paradox. What's fueling this expensive domestic demand?
Let me guess.
The StaalX report is unequivocal. The better-than-expected demand is coming almost entirely from the data center construction boom.
So AI investments are explicitly cited.
They're explicitly cited as keeping market demand humming, while, and I'm quoting here, most other non-residential and residential construction sectors are currently cooling off.
That's incredible. The appetite for steel from data centers is so huge that it's overpowering the cooling effect from the rest of the market combined.
The AI gold rush is literally making materials more expensive for everyone else. Imagine you're a small contractor trying to buy rebar for a foundation. You're indirectly competing with a massive contractor who needs metric tons of steel for a data center shell on an accelerated schedule.
That urgent, specialized demand drives up the cost for the little guy, who's already dealing with a shrinking pipeline of work.
Yeah, and the market complexity makes it worse. The report highlights serious inventory gaps right now. Some common sizes of rebar and wire rod are, quote, impossible to find for quick delivery.
So even if domestic mills try to ramp up, it's a slow process.
It's very complex, which means for the first half of 2026, high domestic steel prices are actually making imports viable again, even with the tariffs. And that just confirms it. Material cost inflation, caused by the data center boom, is the #1 source of the profit squeeze for everyone.
They'll sell more, but they'll make less on each sale because steel is just eating the margin.
So what does this all mean for you, whether you're tracking investments or just trying to understand the market?
We've resolved the paradox. The construction market is on a deeply segmented K-curve. Confidence is high, but that confidence is either a bet on the future for residential.
Or it's fueled by the hyper-specialized current demand from these massive commercial data centers.
The essential reality is that the average contractor is caught in a profit vice. Their backlogs are shrinking, especially for smaller firms.
And their material costs are rising relentlessly, all because of the data center gold rush. That boom is the single common denominator here. It links rising costs to falling pipelines.
So if your firm or your focus isn't part of that AI investment wave, your reality on the ground looks completely different and much more challenging than what the positive headlines suggest.
The division is stark, and the cost pressures are real.
Final thought for you to chew on then. Since the high prices for critical materials like steel and the robust backlogs for the biggest firms are so heavily reliant on the aggressive pace of this AI-driven construction.
How fragile is the health of the broader construction market? What happens to steel prices, to backlogs, and to overall confidence if that flow of tech investment slows down or hits a regulatory snag next year? That dependency is the key vulnerability to watch in 2026.
Thank you for listening. Explore more at www.StaalX.com.